In the previous chapter, we went through a call spread example. We named the call spread, went through how to get to maximum gain, maximum loss, break even, and discussed the point of the spread overall. And in this video, we're going to do the same thing for a put spread. Now, first and foremost, a put spread is involved whenever we are long and short a put simultaneously. And sure enough, that's what we have here. We are long 1 March 75 put and short 1 March 90 put. Now, this is a put spread, specifically a put price spread, where we see that there are similarities between the two March expirations, but a difference in the two strike prices. We also call that a vertical spread. The first thing we'll talk about is how to name this spread. If they had given us premiums, the option with the larger premium would be the dominant side and therefore would name the spread and define what the purpose of the spread is, but we don't have that here. With put spreads, we can rely on the strike price, specifically the high strike price, to tell us which side is more important than the other. And that relates back to how a put works, right? A put contract gives whoever owns it the right to sell. And doesn't matter that we bought or sold the 75 or the 90 put here. The reality is the 75 put gives someone the right to sell at 75 versus the 90 put gives someone the right to sell at 90. Therefore, we think about those two contracts together, the right to sell at 90 should be a more valuable option, and therefore the 90 put will be the dominant side of our spread here. With that being said, we can name this put spread now that we have identified the most important part. Because the short put is the dominant part of the spread, this is a short put spread, also known as a credit put spread. Now remember, if we're selling the more expensive or the more valuable option and buying the less valuable option, then overall we'll end up with a credit. That's why we call it a credit spread. And last, we call this a bull put spread because short puts are bullish. Now, we'll talk about why specifically this investor here with this strategy is considered a bullish investor or why this is a bullish strategy. We'll talk about that. But first, let's go ahead and assign some premiums and work our way through maximum gain, maximum loss, break even. Just like we did with call spreads, we're going to follow the same 4-step system to get to the 3 answers that are very heavily tested on the exam. Maximum gain, maximum loss, break even. We will also talk about widening, narrowing, expiring, exercising, and also the above below question. We'll talk about those at the end. First step, we're going to net out our premiums. And that's going to tell us actually either the maximum gain or maximum loss, depending on what we get. Now, the difference between 6 and 14 is 8. And because we sold the more valuable option, we have an $8 credit on our hands. This investor here starts the strategy receiving $800 right from the start, and that is their maximum gain. Remember, if you start with a net credit, that's your maximum gain. If you start with a net debit, that's your maximum loss. Next step, we're going to find the difference between the two strike prices, which is 15. That's the only step that doesn't tell us anything, but it's an important step to get to the next thing, which is we're going to take our net strike price of 15, subtract out 8. And again, try not to think about the 8 as a positive or a negative. Just what's the difference between the number 15 and the number 8? And the answer is 7. Now that tells us the other max, meaning we figured out maximum gain up front. Therefore, this is going to tell us what our maximum loss is. Our maximum loss with this strategy is $700. Last step. To find the break even, we have to go back to our original net premium, which was 8. Now, it doesn't matter if it's a debit or credit, doesn't matter, but we take that original net premium, and as a reminder from the last video, with spreads, the break even will always be between the two strike prices. So we should know right away it's going to be somewhere above 75 and below 90. It has to be. So with this one here, with a put spread, we have to remember that we count down, and some people remember that as a part of put down, right? We count down from the high strike price. 90 minus 8, that's going to get us to 82. Therefore, our break even here is 82. Now, if this was a call spread, we would add 8 to 75, and that would get us to 83. 83 would be our break even there, again, if we had a call spread. But you've got a put spread, therefore the break even is 82. That's your 4-step system to getting to the 3 most common questions that you'll see on spreads. Now, from there, I think it's important if we talk a little bit about what's going on here. What's the purpose of this? Why is this investor going short the 90 put and long the 75 put? What's the overall intent? So let's talk through that. And we're going to think about this through phases, okay? Meaning Let's think about it first above 90. What happens above 90? If you remember, again, this is another area where call up, put down comes into play. Puts are in the money, meaning that they will exercise only if the market price goes down, put down, only if the market price goes down below the strike price. So above 90, both options are out the money, and therefore they would expire if the market price stayed above 90 from that point to expiration. Now, if that were to occur, if expiration occurs, then the investor's stuck with whatever they started with, which in this case is actually a benefit. That's best case scenario. This investor here would actually keep their $800 credit, both options would expire, and that would be the end of the story. And $800 is their maximum gain. So if you remember back to one of the very first things that we talked about, this is a bull put spread, and that's why. We want the market price to stay above 90 so that both options expire worthless and that the investor keeps their maximum gain. Now, what happens below 90? Below 90, the short put goes in the money, which is not good. You got to remember, in the money is good for the buyer of the option, bad for the seller of the option. So in this case here, as the market price goes below 90, the short put starts gaining intrinsic value. It goes further in the money, and the further it goes down, the more money the investor loses on the short put. Now, it's no mistake that once they get down to 82, the contract is now $8 in the money. That works against the investor, right? If the market price went down to 82, the investor, you can assume, would get exercised on their option, and that's when their obligation would kick in. They have an obligation to buy stock at 90, even though that stock is only worth 82, and that's an $800 loss if they were forced to do that. Now, that $800 loss would offset the $800 that they made up front just by starting off this option and kicking it off with a credit. That's why we're at break even there. Sure enough, the further the market goes down from there, the more money that short put position loses. Now, here's the good news, is that once we get below 75, both options go in the money, and it's almost like we have a long put. It's almost like it comes in riding in to save us, right? That long put will start making the investor money as the market goes below 75, and therefore will start offsetting the losses of the short put. So we have an offsetting mechanism here below 75. And that's really the point of the long put. The long put's not really there to be a moneymaker for the investor. It's more there to offset losses if the market price were to fall below 75. And as a reminder, remember, this investor is bullish. So that 75 put is kind of like a hedge for them. It's protection in case the market price were to fall. And that's what's happening here. So to bring the full picture together, this investor here is betting that the market price is going to stay above 90, and they think they're going to keep their $800 credit. Now, if they were very confident about that and they thought that there's no way that's not happening, they probably would have just sold the put. Selling the put would have put $1,400 in their pocket. But the long put, they spent $600 on that. The long put provides added protection in case the market price were to fall. And really, to me, it's almost like you have someone falling, and then that long 75 put is almost a parachute for them as they kind of come down and lose money as the market goes down. That long put is there for protection. So this investor here felt it was worthy enough to invest $600 into some protection that would then benefit them if the market price were to fall drastically. That's what's happening. We have a semi-bullish investor here who thinks the market's going to stay above 90, but they've got some protection in case the market price falls below 75. Otherwise, remember, with a short put, this investor could lose money all the way down to zero, right? If that short put was all by itself, the maximum loss would be 90 minus 14. So $7,600 would be their maximum loss if they didn't buy the put, right? But they did. They've got some protection. That's the point. Now, going to the other questions that we have here, we have a credit on our hands. So the words we're going to associate with credit are always going to be narrow and expire. Remember that 6-letter thing, right? Credit 6 letters, narrow 6 letters, expire 6 letters. We put them all together, and hopefully the expiration part of that makes sense. If the market price stays above 90, both options expire, the investor keeps an $800 credit, which is their maximum gain. That's what they hope happens. Now, if this was a debit put spread, we'd say debit, 5 letters, widen, 5 letters, exercise, 7 letters, right? But that's not what we have. Now for the last part. What if we see a question that says something like, below which dollar price does every dollar gained by the long option offset by a dollar lost on the short option? Remember from our last video when we went over this, the answer here is always going to be one of the two strike prices. So right away, we know it's got to be 90 or 75. Now, the second question, or the second way to get to the answer, is if they say below, it's going to be the low strike price. And that's what we have. So the answer here is 75. And if you're looking at the drawing that we have at the bottom right of the screen, where do we see both options start offsetting each other? It's below 75. That's where that occurs. So to summarize, this investor here has established a short put spread, also known as a credit put spread, also known as a bull put spread. They think the market's going to stay above 90, and if it does, they keep their maximum gain of $800. Worst case scenario, market price falls, and if it falls to 75 or below, they're locking in their maximum loss of $700. And there are varying gains and losses in the in-between. Overall, this investor is hoping that both options expire, and that's the goal. They hope it stays above 90, and that would be their best case scenario.
Hi, I'm Brandon. If you enjoyed this video, then you'll love the courses I authored with Achievable. They include tons of real-world examples, more videos just like these on dozens of key topics, a built-in study planner, hundreds of chapter review questions, and unlimited practice exams. Our courses are competitively priced, and you can try them out for free first to see if our style is the right fit for you. Follow the links below in the description to get started.